A lot of people are under the general impression that a mortgage payment is just one thing that takes care of everything. Well, to some effect, yes, but in reality, a mortgage payment is made up of four key components or four primary elements, right? And the four key components of your mortgage payment is this: principal, interest, tax, insurance. Again, principal, interest, tax, insurance. And when you put principal, interest, tax, and insurance together, you make an acronym. And the acronym is called PITI, or the PITI payment. Now, PITI payment, it might sound appropriate if you say PITI payment in the sense where, oh my gosh, I have to make this big payment for every month for the next 30 years of my life. Yeah, that's a PITI indeed, but I'm not talking about that PITI. I'm talking about the acronym for principal, interest, tax, and insurance. Now, let's start out by examining the principal. Now, what is the principal? The principal is simply this. The principal is that flat out amount of money that you borrow to pay for the property. The principal is the sales price, or that direct dollar value. The principal is the amount of money you borrow in order to get the property for yourself. That's the principal. It's pretty straightforward, pretty simple. It's the sales price, essentially, minus anything else. Flat out sales price. So now, what is the interest? Well, the interest is something that we all hate, right? Straight up. We know that the interest is basically the amount of money that you have to pay someone to borrow their money. Simple and straightforward. The interest is the amount of money that you have to pay someone to borrow their money. The interest is usually measured in percentage, right? Now, let's think about this. What affects your interest? A few things affect your interest: your credit score, your down payment, and the type of mortgage that you get. So you could get an FHA, which is usually 3.5% you put down, or you get a conventional, which is a higher amount that you put down, right? So we have to be keen on those things. Interest, again, is the amount of money that you have to pay someone to borrow their money. Now, tax, that's something that we all hate as well, but guess what? We have to pay it, right? So the tax is basically, as someone else say, we'll call it your property tax, right? We have to pay property tax. If you live in this country, you have to pay property tax. I don't really know about any other country, but I know about this country, and this country is all about tax, right? Well, taxes are important because that's how the cops get paid, that's how the firefighters get paid, that's how the sanitation workers get paid. If there's any need for any improvement in the town, like the streets, the sidewalks, and so on and so forth, guess what? The property taxes pay for that. Now, with the taxes, it's this. The tax is usually figured by an assessor. So an assessor comes to the house, looks at the house, sees the condition of the house, sees the earning potential of the house, looks at the improvements that have been made. Like, for example, was the sidewalk in front of your house repaired recently? All those things factor in to affect your property tax. Now, you can't escape paying a property tax. Even if you've completely paid off your house, you paid off the bank, you owe no more money, guess what? You still have to pay your property tax. As long as your tax is located within that particular municipality, you have to pay the tax. And that's just it. We can't escape it. Hey, this is America, right? So the next part of the PITI payment is something we call insurance. Now, insurance is determined by the type of loan that you have, right? Some lenders require that you have to pay insurance. You can't escape it. And insurance also protects your property from, say, fire or flood or a storm, or even a giant branch falling on your house and destroying like a portion, destroying your roof. So insurance is important, and most lenders make it a requirement that you get homeowners insurance. Also, what the insurance also does is this. It also, let's put it this way, it also helps the lender. It also insures the property from default, right? So if you can't make your payment, you've made some insurance payment that could help to cover the default, basically. So you have to pay insurance. It's a vital part of it. So again, the insurance, it protects the loan, and it also protects the property from fire, flood, a giant branch falling off a tree, the tree falling in your property, that type of stuff. Any kind of natural disasters or anything like that. So again, just a quick recap before we go any further. Your mortgage payment is made up of 4 key elements. And the elements are principal, interest, tax, insurance, and it's called the PITI payment. P-I-T-I. It's an acronym. Now let's dive in a little deeper. Your principal is something that you have to pay, right? You have to pay down on your house. You can't escape your principal. That's just what you borrowed. That's what you have to pay back. The interest, you can't escape the interest either. Unless you're gonna buy that house straight on cash, you're not gonna borrow anyone's money, you have all the money, then fine. Because again, the interest is the amount of money you pay someone to borrow their money. So if you have all the cash, you can pay for that house yourself straight up, or you just wanna, somehow get the money. I don't even think that's legal to give someone that much money. Boom, here's the payment for the house. They're gonna report you to the what do you call it? I think the Secret Service or somebody. I don't even remember. But to put down that much money, they're gonna have to report you to the federal government, and they're gonna investigate. So, kind of seems like we can't really escape interest, right? Now, taxes. You have to pay the taxes. A lot of time, people lose their property because they don't pay the taxes. That's key. So, taxes are a must. Insurance, generally, I think within maybe a number of years, maybe even after the first year, you can slash some of the insurance, but most lenders require that you maintain that insurance payment for a long period of time. So it's also something you can't escape, right? But the good thing is that the insurance is not really that crazy. So know this and take this into consideration. A certain portion of your monthly payment goes towards paying the principal. Another percent goes towards paying the interest. Another percent goes towards taking care of the taxes. Then the remaining percent goes towards the insurance. Now let's use this example, right? Let's use a nice round number. Let's say $1,000. So let's say your monthly mortgage payment is $1,000 a month, right? So early on, 20% of your monthly mortgage payment would go towards the principal. Then another example, 65% could go toward the interest, 10% could go towards the tax, and 5% goes towards the insurance. So 20% plus 65% plus 10% plus 5% equals to 100%, right? So let's break it down. So in other words, if your mortgage payment is $1,000 a month, $200 could go towards the principal, $650 could go towards the interest, $100 could go towards the tax, and $50 could go towards the insurance. So that's how it works. Your mortgage payment is broken up into percents, and the varying percentage portion goes towards taking care of different parts of the PITI payment, right? So one thing you notice here is that when you start when you start paying your mortgage payment early on, when you get the property, majority of the payment, the greater percentage of the payment will go towards the interest. But as time goes on, the percentage of the payment that goes towards the interest will decrease as the percentage that goes towards the principal increase. So for example, with the numbers that I gave you earlier, so 20% of the payment could be going towards the principal, while 65% is going towards the interest. As time passes and you're paying down interest, because that's the important thing, these people want you to pay down interest first. So when you pay down the interest and the interest percentage portion drops from 65% and start going down to 45% and so on and so forth till it gets to 1%. This is way in the future now, when you've been paying that mortgage for many years. As the percent that goes towards the interest decrease, the percentage portion that goes towards the principal will increase. It's very interesting. It's almost like a reversal type of compensation thing that's going on between the interest and the principal. As one goes down, the other comes up. So just remember that. So again, my name is Ian Robinson. I'm a realtor in Northern New Jersey. I'm here to help you guys with any and all of your real estate needs. So if you need to buy, you need to sell, hey, contact me. I'm the man for you. Thanks for watching. Peace out.